Good afternoon, everybody. Welcome to this webinar. We will be getting started in just about 1 minute. We'll give folks a few more seconds to join us. Just a reminder, if you're on now, that you can submit questions as we go along in the Q&A box at the bottom of your screen. Hey, I think we should go ahead and get started. Good afternoon, and thank you all for joining us for today's webinar on the economic consequences of weak governance and political instability, co-hosted by the Niskanen Center and the Budget Lab at Yale. The United States economy has exceeded recent expectations and the performance of many of our peer countries, but current and future policy has the potential to undermine the foundations of our economic performance, particularly if our political stability and the quality of governance decline. So this webinar today will explore several perspectives on how increased political risk and declining governance quality could damage our credit rating, our investment environment, our ability to attract immigrants, and our economy. So we have a terrific group of experts to walk us through this today. Ed Dolan is a senior fellow at the Niskanen Center. He's the author of the recent Niskanen paper, Good Data on Good Government. Reformers Should Take Note as Political Philosophy Meets Statistics. We also have Michael Strain, who's the Director of Economic Policy Studies at the American Enterprise Institute. His research and writing spans a range of areas, including labor markets, public finance, social policy, and macroeconomics. We also have Ernie Tedeschi, the Director of Economics at the Budget Lab at Yale. Ernie is the author of the recent Budget Lab report, Political Risks to the U.S. Safe Harbor Premium. So we'd like to just remind you, if you've joined in the last few seconds, that you can submit questions during the conversation as we go in the Q&A box at the bottom of your screen, and we'll try to get to some of those, as many as we can, at the end of our discussion. But we'd like to kick it off by giving each of our panelists a few minutes to make remarks on this issue, share their perspective, and why don't we get going with Ernie?
Thanks, Kate. And first of all, thanks to Niskanen for hosting on this timely topic, maybe timelier than any of us thought a couple of weeks ago. And I really look forward to this conversation with Ed, Michael, and Kate. To help set the table for the conversation, I wanted to make a few brief remarks, mostly summarizing the report that Kate mentioned that I wrote for the Budget Lab back in May on the U.S. Safe Harbor Premium. So you can find that, by the way, if you go to budgetlab.yale.edu. So first, a lot of the global political risk analysis that you might read on country risk rightfully focuses on the probabilities and consequences of specific events. So if you were going to read a political risk analysis of American political risk, for example, you might read a political risk analysis of, say, the chances of a debt ceiling breach. So what are the chances that it actually happens? What would happen to the dollar after the breach happened? What might the Fed do? What might the Treasury do? In the Budget Lab report, we took a slightly different approach. We looked at the economic consequences, even from just the heightened risk of negative political events, even before they happen at all. We looked at that risk through a market lens, through a concept of what we call the country risk premium. And you can think of the country risk premium as the lower return that investors are willing to sacrifice because of the safety and soundness of the American economy, American institutions, American rule of law. And what we found in the report is that even without an actual damaging political event, if concerns about American institutions arose such that the U.S. safe harbor premium deteriorated, not to the level of, say, an emerging market economy, but say to the level of just an advanced economy such as the UK, domestic and foreign investment would be slightly lower over time. In the case of, deteriorating to the level of the UK, over 10 years, US real GDP would be about 1% lower over 10 years. And real stock market wealth would be about $50,000 per household lower over 10 years. In other words, just that slight incremental increase in risk would build over time. There would be less investment and we would be poorer. So I think that that's why, even without an actual event, the risk of risk really matters for this conversation. The second point I would make is that US political risk isn't zero. Now, I think that here and now to this audience, that might seem absurdly obvious, but a zero country risk premium for the US is a pretty conventional market assumption to make. So to relax that assumption, in the Budget Lab report, what we did is we took estimates of the country risk premium from NYU Stern professor Aswath Damodaran, not necessarily because they're right, but because he took a very straightforward, I think, conventional approach to estimating the country risk premium for different countries. And we looked at the relationship to his country risk premium estimates to independent metrics of political and financial risk from various independent organizations like PRS Group, the World Bank, and the IMF. What we then did was we estimated what the US country risk premium would be if its relationship to those metrics was the same as the relationship to the country of the country risk premium of those other countries to those political and financial risk premiums. And then we map that onto US space. We call that the US shadow risk premium. What we found is that US shadow political risk is consistent with about 25 to 35 basis points. So what is that? To put that in perspective, the UK had a country risk premium of about 50 points in 2017 in the wake of Brexit, and 90 points at the beginning of this year. France had a country risk premium of 70 basis points at the beginning of this year. And Italy was 320 basis points at the beginning of this year. So, what our analysis is saying is that the US country risk premium is probably not high for an advanced economy, but it's certainly not zero. It's also rising. Our analysis suggests that it's risen by 20 basis points since 2016. The third point I would make is that markets appear really bad at pricing political risk ahead of time. In fact, they seem to price it, rather than pricing it smoothly and rationally over time, they appear to price it suddenly. And we can talk about this more in our conversation, but they appear to react to world events and suddenly correct, rather than anticipating world events and listening to smart political analysis. We saw this with the debt ceiling crisis in the US in 2011. I think we saw this with recent European elections this year. And I would argue that we're actually seeing it right now as the market struggles with how to price the US presidential election. And then the last point I would make, and I'll end on this note, is actually an optimistic note. I think if you look through the narrow aperture of the last decade, certainly political and institutional risk in the United States appears to have risen. But I think the optimistic angle is that if you take a step back, I would be a little bit more sanguine. We sometimes forget that Federal Reserve independence, for example, is a relatively recent phenomenon. As recently as the 1970s, within the lifetime of many on this call, Federal Reserve independence was in doubt. And I think that you would be hard pressed if you went back to the 19th century, for example, when we had ballot stuffing and boss politics, that United States institutions are more corrupt and politically captured than they were back then. So the deteriorations that we're talking about today are definitely concerning and ought to be a focus of policymakers, but these deteriorations are not destiny. So thank you, and looking forward to the conversation.
Thanks very much, Ernie. And yes, we'll definitely want to dive into more of that, especially the election. So fair warning up front that I'll have some questions on that. Let's turn it over now to Ed Dolan to give us his perspective on this issue.
Okay, great. Thanks. Glad to be with you here. Over the past few years, I've done quite a bit of research on measurement of quality of government around the world, both in democracies and autocracies. And I'd like to take a minute to pass along a few takeaways from my research that relate to today's question, the ways that political risks and slipping quality of government could damage the American economy, which up to now, as you pointed out, has been doing pretty well. First, some good news. The good news is that if we take one of the most basic measures of quality of government in the United States, which would be what we call state capacity, which is the ability of a government simply to accomplish whatever goals it sets for itself, state capacity in the US looks pretty good. I rank the United States at 21 out of 166 countries in the database that I'm currently working with. And that puts us right about in the middle of the pack of 40-odd liberal democracies around the world. So that's the good news. The bad news is that if we break state capacity down into its individual components and some of the underlying variables, we find out that some of these things that go into the good ranking are fragile and prone to slippage. Let's look, for example, the most important, perhaps, component of state capacity is administrative capacity, basically how well the bureaucracy functions. It looks pretty good for the United States at the moment, but there are some risks. And on the broadest political level, the list comes from really what the populists call the war on the deep state. The deep state is the pejorative name for the professional civil service that really keeps government running. And we hear a lot of talk about the possibility of politicizing, or perhaps I should say repoliticizing, the civil service in a way that would really take us back 150 years or so when we first had a professional civil service established in this country. That's sort of a general, vague, but real threat. But if we look at something more concrete that's already happening, this is already started. For example, we have a recent decision by the Supreme Court that reverses the Chevron precedent that gives more latitude for independent agencies. And I think that a lot of people haven't really grasped the degree to which reversal of the Chevron precedent could undermine the administrative capacity in the United States. There's also threats to fiscal capacity, by which we mean the capacity to manage the budget, deficit, debt, and so forth. Here, my work is really complementary to what's going on at Yale. Just like them, I use country risk premiums and country credit ratings as a primary measure of fiscal capacity. And the Yale's work, as Ernie's pointed out, suggests that the standard data that I use and everybody else uses overstates the actual fiscal capacity of the United States. If you, I've just done some back of the envelope calculations, suggest that using their shadow risk premium by itself, even without further change, would knock America down maybe as much as 5 notches or something on the state capacity scale, completely non-trivial. Let me turn now to most recent direction of my work on measuring government, which focuses on something I call rule following behavior, rule compliance, as an important determinant of state capacity. By rule compliance, what I'm looking at is a set of 4 kinds of rules about how government operates. We got rule of law in the conventional sense. We've got rules that constrain executive power, like succession rules and checks and balances. We got rules that enforce government integrity and fight corruption, and a package of market-related rules that include things like property rights, contract enforcement, and regulatory quality. So here are, why does rule compliance matter? Well, it turns out to matter a great deal. one of the first questions I asked is, which is more important for state capacity, democracy or rule compliance? Now, if we look at the relationship between state capacity and democracy in isolation, it's very strong. Democratic countries definitely have higher state capacity. If we take a multivariate approach and include and measure rule compliance, somewhat to a degree that really surprised me the first time I ran the numbers, it turns out that although statistically both democracy and rule compliance matter for state capacity, rule compliance is hands down more important. And example of how important it is that we find that rule compliance is equally important, maybe even more important within the universe of autocratic states as it is within the universe of democratic states. So that the highest capacity autocracies around the world, countries like Singapore, Emirates, Qatar, are very strong rule followers. Whereas other countries like Russia that are weak in rule compliance are way down the schedule in terms of state capacity. And a third thing I would like to raise, takeaway I'd like to raise, is that here in the United States, we really have some major threats to the degree to which the United States is going to remain a rule compliant country. In a recent international Ipsos poll, 40% of Americans agreed with the statement, quote, to save the country, we need a strong leader who is willing to break the rules. Only 27% of Americans disagreed with that statement. The rest of them were wishy-washy, thought it might be a good idea to break the rules, at least sometimes. And again, this is not something that's just a vague political threat, although that's really looming over us. It's already starting. Again, turning to the Supreme Court, we have the decision on presidential immunity. I mean, talk about a breach of rule compliance. This opens the barn door wide. It could really be a disaster for rule compliance and state capacity and quality of government in general. Anyway, those are some of the biggest risks I see to government, and I hope we can get back to some of the more specifics on them in the discussion.
That's great. Thank you so much, Ed. Now I'd like to turn it over to Michael Strain to weigh in here. Imagine sometimes, Michael, you are the foil on the panel. You can bring a different perspective. So are you going to show up with that today? Let's hear. What do you think?
Well, I'll thank you, Kate, and thanks for having me on this, and I'm excited to be here with Kate and Ed and Ernie, all of whom I respect very much and learn a lot from. I'll maybe foil later and just keep my remarks here brief because I'm eager to kind of dive into the discussion. I just wanted to make 3 points to start off with that are really kind of conceptual points about framing. The first is that we're talking a lot about risk, but I think it's important to distinguish between risk and uncertainty. Right now, for example, there's a great deal of policy uncertainty because we don't know who's going to win the presidential election, and we don't know a whole lot about what either major party nominee would want to do in terms of a policy agenda when elected. I think that's different than risk. Risk is, I think, thought of as a situation where you kind of know, things that might happen, and you can perhaps even assign subjective probabilities to those things. I think you can look at previous examples of policy uncertainty to highlight the difference here. President Trump's trade war, for example, I think is often talked about in terms of risk, and there is a risk component to it. But I think the bigger drag on investment during the trade war actually just came from uncertainty about, people not knowing what was going to happen, not knowing the specific structure of the tariff regime, not knowing how long the tariffs would remain in place, not knowing which countries would get exceptions made, which categories of goods would get exceptions made. And so this dichotomy between risk and uncertainty is one that I think is useful in thinking about these issues. Second point, I do think that the United States does face structural risks. Political stability is a risk in the United States today, in a way that I don't think it was in the 1980s or 1990s or in the aughts. The quality of governance, I think, is a risk in a way that I don't think it was previously. But again, I think it's important to underline this difference between risk and uncertainty. A lot of the structural risk, even when you're kind of thinking about these longer term issues, I think maybe better thought of as uncertainty. And then a third point, I think it's worth thinking about kind of what's the nature of the problem. Do we expect this problem to manifest itself in the form of a crisis, or do we expect this problem to kind of be more like a termites in the woodwork problem, where you don't really notice the effects of this increased risk on a daily or weekly or monthly basis, right? Things kind of look pretty much the same today as they did a month ago. They'll look pretty much the same a month from now as they did today. But over time, over a period of time, there's kind of cumulative damage. Should we think about this as a termites of the woodwork problem, or should we think about this as a problem where one day we're going to wake up and all of a sudden the 10-year yield is going to be 50 or 100 basis points higher than it was because something happened. Ernie kind of got at this a little bit in his introductory remarks, so that could be an interesting angle to discuss. And then I think finally, and maybe here I'm playing the foil a little bit. I do think it's important not to overstate the degree of the problem here. And I think the problem is in danger of being overstated in two ways. I think that there is a pretty widespread tendency to overstate the degree to which, at least in my judgment, to overstate the degree to which President Trump is capable of substantially affecting the stability of American institutions. If you look at the president's first term in office, President Trump's first term in office, I think what you see is that the judiciary held up. I think you see that the U.S. Congress held up. I think you see that the media held up. I think our institutions were stretched and tested. But I kind of think they passed the test. And that I think is an important factor to consider. And secondly, I think I think risk and uncertainty, it's always helpful, I think, to say, compared to whom. The United States is riskier. The United States is riskier. Okay, that's kind of a relative comparison. Relative to America in 1994, sure. But when I look around the globe today, I see less stability, kind of across the board than I saw in the 1990s. And it's not clear to me that that the United States is less stable than France, less stable than the United Kingdom, less stable than Japan, less stable than many of the countries that you might think could be an alternative for investors. So maybe that's a note of optimism.
Great, thanks, Michael. A lot to talk about here. Just a quick reminder that you, the audience, people watching at home, can submit questions in the Q&A. So we've got a few already, but please keep them coming. I think it makes sense to just kind of put it quickly to Ernie and Ed. I think Michael's point about is this all a bit overstated? We could look back during the Trump administration and see times where these institutions were tested and seem to have held up well. Should that be comforting, or why should we be more worried, perhaps in this moment with the prospect of another, a second Trump administration?
Yeah, I take Michael's point very seriously, which I think it's very easy, especially when you're thinking in the long run, to go overboard, and you're thinking about small effects building up over time, and pretty soon you come up with very extreme examples. The classic example in the growth literature of countries diverging over time is, right, Argentina, that went from one of the richest countries in the world just 100 years ago to, an emerging market economy today. And I don't think we're talking about the United States becoming Argentina over time. I don't even think we're necessarily talking about the United States becoming Italy over time, which is a very nice, still rich country, that just has a lot of corruption and has, a relatively high, risk premium if you ever wanted to invest there. I think we're talking about the United States starting with an extremely high advantage in terms of governance and finance. I mean, remember, the United States issues the world's reserve currency. It issues the world's, most liquid asset that is denominated in the world's reserves currency. It, as the world's largest military, I mean, like, it is the center of world financial culture, military, all of the most important aspects of world power. We're talking about that deteriorating a little bit over time, and I think us becoming a little bit poorer than we otherwise might have been. And what I was trying to convey in my original remarks is that, yes, there is a risk here that there actually is a specific event, ranging from a debt ceiling type event, a trade war, another January 6th type event. Everybody can think of something specific, where there is a risk or an uncertainty, and talk about the specific consequences, or that the fear of those events rises, and investors hesitate just a little bit more in investing in the United States, and so as a result, we're just a tad poorer. But I will say that I think that Michael makes an excellent point, which is that when you look at the political dynamics around the world, this is not necessarily a unique dynamic to the United States right now. And we could be having this conversation in a lot of different places.
Ed, and anything that you want to add there?
Yeah, if I could stick in a comment there. Yeah, I appreciate Ernie's optimism. I mean, Michael's optimism in terms of saying that even if we get a second Trump administration, that it might be no more able to carry out its program than the first one. I don't know. Certainly, a second Trump administration is being much more carefully planned than the first one, and a lot more thought in terms of selection of personnel and what would be done, laying grounds in terms of the judiciary and so forth. Seems to me the risk is greater there than it was the first time around. I'm also, another symptom of that that's relevant is I'm a little bit disturbed about the fact that fiscal management, management of the debt and so forth has dropped out from being a centerpiece of the GOP platform to being something that's barely an afterthought. That's concerning to me in terms of the quality of fiscal governance. Michael also raised the issue of whether or not this is something that could happen suddenly or whether it's just termites in the woodwork. Are we in Italy? Are we Japan? Are we whatever? I think one thing we might think about is maybe we're in China, where China was the giant of economic growth for really 3 decades, amazing engine of growth. And the termites accumulated there, and all of a sudden it slowed down to a crawl so that the Chinese economy isn't growing any faster than other places. It can happen suddenly. And one thing that's concerning to me is that that was accompanied by a serious decline in rule compliant behavior in China, beginning with Deng's reforms in the 1980s and 90s. A lot of that was built on trying to create a rule-based governance system in China. Things like term limits and independent courts and dependable property rights and so forth. That's been undermined with remarkable rapidity in China ever since Xi decided to ditch the idea of term limits. And we see that that has very quickly showed up in terms of manifestly slower Chinese economic growth and underperformance. So I guess the bottom line here is that although Michael and I are looking at the same risks, he's a little bit more optimistic about them than I am.
I'd love to know from each of you, whoever wants to weigh in, just which U.S. institutions do you think are most vulnerable to political risk right now? Ernie, do you want to start?
So the political institutions that concern me the most are, first of all, the Federal Reserve, because I think that the Fed has become more central to policymaking over the last 20 to 30 years. As government has become more divided, the Fed has become more proactive and it has become more central to macro policy. So I am worried that in an environment where inflation has become a constraint, and we have discovered, obviously, during the pandemic, inflation as a constraint, the Fed as a barrier to expansionary macro policy will be more vulnerable to political influence in the future. I'm also very much worried about the government agencies that produce data, not because of the civil servants, who are some of the most dedicated statisticians and economists I've ever met. So there is very much a culture of independence and data focus there, but they are under extreme budget constraints, and that's unlikely to go away anytime soon. So tough choices have to be made. There are tough choices being made now when they're not under political influence. And I'm worried that, that sort of those pressures will come and then collide with potential political pressures in the future over certain, data questions. And the reason why that worries me is that everybody, businesses, academics, people throughout society rely on government data for all sorts of insights into American society. And if that becomes more unreliable, then both risk and uncertainty rise.
So I think my first response to your question is to say that I agree with the general frame that political risk is kind of elevated across the board. There are some institutions that I feel better about than I would have a few years ago. Again, I think the courts have shown substantial independence from the executive branch and from the White House, and have really kind of held up in the face of pressure. I think the Fed is, like Ernie, an institution that immediately comes to mind. Ernie mentioned that Fed independence is relatively new, but kind of dated it back to the 70s. I would actually date it back to the 90s, maybe. I mean, Paul Volcker came under considerable pressure from the Reagan White House, for example. There's actually some new research on this that's pretty enlightening. And President Trump did not respect the independence of the Fed in his first term in office, and I expect that would certainly continue if he were reelected, and if he were reelected with a big or not even a big, but a majority in the Senate, that he that definitely could be a problem. I think that a lot of the industrial policy of the Biden administration, the Inflation Reduction Act and the CHIPS Act, comes with it quite a bit of political risk in the form of cronyism, in the form of regulatory capture. You're already seeing the CEO of Intel ask for a second CHIPS Act, for example, and a major concern I have with both those laws is that businesses start kind of optimizing around currying favor with the government, or receiving additional subsidies, rather than optimizing around some sort of long-term shareholder value notion. But when I kind of step back and think about these risks, I think the United States will be able to weather them, and at some point politics is going to calm down, and maybe that could be as soon as November. Maybe it's going to have to wait till later in the decade. But none of this makes me think the United States. I think it helps to be specific. None of this makes me think the United States is going to look like Italy. Certainly, none of this makes me think the United States is going to look like Argentina. I think it'd be better if we didn't experience this than if we will. But I think the scale of the risk strikes me as on the milder side.
Go ahead,
If
Ed.
I
I see it
put-
looks like you want to jump in.
Yeah, I'd like to put in a comment here. I think that, there are risks everywhere, and the Fed is certainly a sensitive one, but the one I would point to that's really not a risk, because something that's not going to be affected so much by the election is a risk to the performance of the independent regulatory agencies. People love to hate the federal bureaucracy because it's inflexible and slow moving. One of our Niskanen fellows, Jen Psaki, has written a really good book about this, her Rewiring America book. And it's true that regulatory agencies are slow moving, but this Supreme Court Chevron decision or reversal of the Chevron decision is very important. I think we can't understate the importance of that. The Chevron decision, which has stood for decades, gives the benefit of the doubt to rules that are issued by independent regulatory agencies if those agencies are sued. And reversing that means that everything the independent agencies do is open to litigation. Now, one thing that Jen Psaki makes is she talks a lot about what these agencies need, what the direction reform needs to move in is toward greater flexibility, or what the management type people call greater agility. Agility meaning not only being able to make rapid decisions, but to be able to flexibly and informally communicate with the regulated, the people that are subject to the regulations, and make changes when necessary. We got huge changes going on. Things like the rise of artificial intelligence is putting huge burdens on the energy systems, on the transmission system. We need rapid response to notoriously bureaucratic things like permitting new transmission methods and new transmission technologies. And this just at the point where we need more flexible, more agile bureaucracy, we have this Chevron decision coming along, which is going to automatically make everything slower. It's going to gum up the works more. And I'm really worried about that.
I want to ask something sort of about the incredible events that we've seen over the past 10 days. It feels like 10 years. It's kind of hard to believe, but first with the shooting, attempted assassination of the former president at a rally in Pennsylvania, and then President Biden announcing that he was withdrawing from the race, and now we have seemingly a new presidential nominee, Vice President Harris. It seems to me that the reaction in markets, I mean, to use a technical term, they weren't freaking out, right? It was fairly muted. Should we be kind of relieved by that, or should we be worried about that?
Well, I certainly think my optimism about all this should be vindicated by it. That was
You
a
would say
joke
that, right, Michael?
that people didn't laugh. Look, I think markets have been reacting, quite sensibly to a lot of the developments in the presidential election. When it looked like President Trump was gonna take the lead in that kind of durable way, you saw longer dated bond yields drift up because investors were a little more worried about a Republican sweep, which would be inflationary, which would be fiscally irresponsible. You saw some stock prices go up because investors thought that a Republican sweep would be better for corporate earnings and profits. These seem like reasonable judgments. If you look at President Trump's first term, he was fiscally irresponsible. He cut taxes for businesses, and he blew out the deficit, which puts upward pressure on prices. I think people are talking about President Biden's withdrawal from the race as a political event. Will the party consolidate around Harris? Will the convention next month kind of be like the 1968 Democratic convention that's a free-for-all? That's a political consideration. Nobody is questioning, whether if she's nominated, whether that will be legitimate, whether she's in a position to take over the campaign if she wins the nomination. And certainly nobody's saying that if nominated and she wins the election, that there would be questions about her legitimacy just because she entered the race as a candidate in July rather than in January or February. So I think there is uncertainty. I think we don't know what policy agenda she would have. It's not a criticism of her. She just stepped into this role in the last couple of days. And so I think when she makes it more clear what her policy agenda would be. I expect markets will react to that if it looks like she's going to be the winner, in much the same way markets adjusted in terms of interest rates and stock prices when it looked like President Trump was going to be the winner following his debate with President Biden.
So I disagree with Michael. I think the way markets have reacted to this election has made no sense so far. So let me give you an example. So in the wake of the debate, June 27th, clearly your probability of Trump winning should have gone up, possibly significantly up. And this is not a commentary. This is not a normative sort of statement about the policy. But if the probability of Trump winning after that debate goes up, then some probability of his stated policy on tariffs, right, of that being enacted into law should also go up. But what we saw happen in 5-year bond markets was TIPS yields go up by more than nominal 5-year treasuries. So the break even, so that's sort of the difference between those two, which is sort of the closest thing that we have in markets to a daily market equivalent of inflation expectations. It's not actually inflation expectations, but like it's kind of it's a good sort of proxy of inflation expectations. 5-year inflation expectations have gone down since that debate. Now, look, if the probability of Trump winning has gone up, mechanically, your price level expectation should mechanically have gone up. I'm not even talking about the implications of immigration or political influence on the Fed. Like integrated into CPI, which is what TIPS are contractually tied to in the end. And you have to, TIPS are over 5, the 5-year is over 5 years, you average it out, you have some probability, whatever. That should be priced in. Certainly the break even should not have gone down over that time. So it doesn't make any sense to me. And this is, it's par for the course for the way that markets have reacted to other political news. Look at the way that markets reacted to, for example, the French elections earlier this year. Macron called for a snap election after the European elections, and the French-German spread shot up by 20 basis points the day after. Even though the results of that European election should have been clear to any market observer that was listening to any astute political observer in Europe, and was clear to anyone paying attention to regional elections in Europe, leading up to that point. So it's, markets have a tendency, this is what I was saying earlier in my introductions, markets have a tendency, rather than sort of rationally sort of adjust gradually political information as it comes in, they lurch sort of violently to events and reprice them in suddenly as events happen.
So I want to turn to some of the questions we have from our viewers, which are really interesting. But one in particular, it would be, what would you be looking for in markets to sort of what metrics would suggest that political risk is rising, or risks around the election? What kind of market measures? Either Ernie or Michael, or Ed, whoever wants to start.
I would just say that Ernie is right, that we look at these forward bond market, the pricing of TIPS and the like is the best we've got in terms of forward inflation expectations. There may be some doubt here as to whether or not, though, whether the risk is small, or some doubt as to whether the risk is on the side of some kind of collapse of the real economy, which would be deflationary, and other people are pricing in the risk of a collapse of financial responsibility that would push inflation up. We really can't read the tea leaves of the market results quite well enough to know what's going on there.
Ernie, anything you want to add? I know you mentioned obviously a few of the metrics that you looked at that kind of weren't moving much, but anything else to just add to that?
Yeah, and it's forward bond yields, I agree, are probably the best metric that we have. Spreads against corporate rates, spreads against other countries. It's tough though, because it is, and we struggled with this in the administration, because we always had these questions like, what are markets thinking when what are bond traders thinking when they're doing this thing? And you can't go to these auctions or these markets and interview the bond traders and ask them, why did you price this way? Like what were you thinking? Unfortunately, they don't work. We have some surveys of bond traders where they ask explicit questions. I wish we did them more often, because that information would actually be helpful. So I think that's probably the best information we have. And I would also emphasize, actually some of those surveys that we do, the survey of primary dealers that's put out by the Fed, the survey of market participants, the Fed is unlikely to put politically contentious questions in there, but they sometimes do put fiscal questions in there, and they do often ask about expectations of monetary policy, which sort of embed expectations about where the economy is going, and you can sort of infer what market participants are thinking about where inflation is going, and therefore, do they think there's going to be deflation, or is there going to be a trade war, that sort of thing. And so I would look at a constellation of all of these things.
I would look at spreads between the U.S. and other countries. I think that would be the kind of most natural place to look. But I do think it's important to. I mean, markets aggregate information. I think something very insightful that Ernie said was that just to remind that these are people who are making these trades, and Ernie mentioned the debate between President Trump and President Biden, and just anecdotally, while the debate was happening, I received a few text messages from some very successful traders on Wall Street, all of whom thought it was terrible news for President Trump, because they thought that President Biden was going to drop out, and there's no way he could survive that, and their reaction in real time was, this is bad news for Trump. All the people in Washington I spoke with, who are served in the Biden administration or previous Democratic administrations, or were journalists or whoever, there was I think the kind of weight of opinion was that President Biden was going to be able to survive it and weather it. And these communities they don't talk as much as maybe they should. And I think Ernie's anecdote about from his time in government, discussing what are these folks thinking. It's a conversation that happens a lot in Washington. It happens on the Hill. It happens, in the White House. It happens, when journalists are trying to write their stories. And I do think that there's, I think folks who trade in markets and folks in Washington do process information differently. And not to say that one is better or worse, I don't know what the track records would be. But I do think that's, an important or a potentially important thing to think about when trying to think about, how do political events affect financial markets.
I think that that's such an interesting point, Michael. I was thinking about this earlier when Ernie was talking too, on how sort of on the note of how are these views intertwined, I mean, markets may be slow to sort of to react or to kind of catch on to the risks, but you know that next year when we are talking about the debt ceiling and when there's a big debate over it, that there will be lawmakers saying, this isn't really a big deal. Let's do it. Let's just see what happens. There's not going to be a big reaction. Look, at markets are not really worried about it right now. We can take our time. We don't have to sweat it because it's, you know, this event is weeks away or even days away. How much of a challenge is this? And it feels like this has gotten worse, as you point out, Ernie, maybe in the last 8 or 10 years or so, just this idea that markets are sort of unfazed. So lawmakers maybe perceive it as they don't have to worry as much. How is this a challenge for policymakers, for the administration? And is there any way kind of around this problem at this point?
Yeah, so I agree. And look, it's not necessarily irrational of markets because
Markets have been right.
you're right, exactly. Like historically, we have come to deals before. But it's also sort of Russian roulette. You only have to be wrong once, and then all hell breaks loose. And this is and just to go back to what I was saying earlier about the ways markets price this. I mean, like go back to the closest we came to that disaster, which was 2011, and you look at it, if you go back to that as a case study, all throughout the summer when there were these intense negotiations, there was not a lot of market friction going on, with the exception of a couple of very specific Treasury CUSIPs. Spreads were pretty mundane. The S&P was growing just fine. There was a little bit of anxiety in consumer sentiment, but that was it. President Obama and Speaker Boehner came to a deal in July and resolved the crisis. Markets didn't explode until the S&P downgrade on August 5th, which happened after the deal, which happened after the crisis was averted, which I always find amazing. Number one, because S&P got the math wrong at first and then corrected it. But number two, because S&P was really just saying what was already plainly obvious to everyone who was paying attention, which is that there's a problem here with fiscal negotiations and the fiscal politics of the United States and the fiscal trajectory. It was just somebody with authority saying it at that point. And then you saw, triple B spreads exploding and everything else happening. And all of a sudden, there was this market repricing after that happened, not while there was the tension going on. And so, so I guess that's a long way of saying I don't take much comfort. I don't take much forecasting comfort in the calmness of markets because I think markets are taking comfort in the history of the fact that we've gotten these deals done before.
Just really quickly, we're coming up on the end here, but maybe if each of you could take 30 seconds, are there any ways that we could promote good governance? I know, sorry, 30 seconds. I'm really asking a lot. Maybe we'll just kick it to Ed since he didn't jump in on the last one, but just Ed, your thoughts on this. How can we fix this?
How do we fix it? Well, it doesn't look, it's hard to be optimistic about fixing it. The whole tenor of this discussion, the thing that strikes me about it is we talk about the risks. Well, how bad are the risks? How good are the risks? The problem is the risks are not symmetric. The risks are that the U.S. will maintain the position it's had in the past as a pretty good middle of the pack representative of liberal democracies, or is it going to slip? There doesn't seem to be much risk as shows in market prices or elsewhere that will get a whole lot better under the next administration.
I can do 30 seconds. What we are witnessing right now in the Democratic Party is pretty remarkable. And it is the party changing nominees in late July in a presidential election year outside of the primary process. And in my view, the primary process for president, for candidates for the House and the Senate has been a driver of extremism among elected leaders and a driver of instability and uncertainty. And my great hope, and this is more a dream than a forecast, but my great hope is that both political parties might look at what the Democrats are doing right now and conclude that some structural changes to their nominating processes would be helpful to them and to the country.
Ernie, 30 seconds.
Um, my number one dream this year is shortening future presidential elections. Very much admiring the UK and France in that regard. No, but a more realistic hope. Actually, this may not be a more realistic hope. Two things. One, I think that having more, so many of the political fights and extremism stem from fiscal battles, from budget battles. So I actually agree a lot with Democrats and Republicans who want to add some structure to the way that we do budgeting, and those who are calling for more constructive fiscal commissions. I think we need to have those conversations, and I think that we need to do it in a constructive way. One last thing, I would also say, get rid of the debt ceiling, because I think that is. It has served its purpose, and it's now being used for an entirely different purpose. And we should, and this is a implicit criticism of my side. We should have gotten rid of it when we had the chance.
Thank you all so much. And thank you for sticking with us a couple minutes past 4. This was a really terrific conversation. We hope you enjoyed it. And thank you so much to our panelists and to the Budget Lab at Yale and to the Niskanen Center for hosting this discussion. Hope you'll have a great afternoon.
Thank you.